excited to have you guys here today. We're going to talk a lot about some of the basics of credit. Give you some great tools that you can take out tomorrow, the next day, and the next day of advising your clients on the best thing to do and how you can help them. And also, too, we're going to teach you a lot of how to take your turn downs and turn it into approvals. We're going to do a lot about that and go into some details and show you the mistakes on credit reports, how to recognize them, and to see some of the most common mistakes that you see, and a lot of the common problems they have with collections. So we'll kind of jump in. If you haven't already, dropped 2 business cards here. We're going to give them a scan on the way up front. So if you haven't got business cards yet, we'll pass that bowl around. We'll draw at the end. But we'll jump in and we'll try to have a little fun today. Rather than just boring old credit reports, we're going to actually talk about the top 5 myths. And myth number 1, you only have one credit score. Everybody kind of hears that and they think, I've got 3 of Transunion, Experian, and Equifax. And that's really important to understand. There's 3 main credit bureaus, Transunion, Experian, and Equifax. But inside of that, there are 43 different versions of your credit score. So everybody has a FICO, but there's 43 different versions. The good thing for you guys is to know that the only version that's really important for you is version 4. And that's because Fannie Mae, Freddie Mac, and FHA dictate that that is the model that has to be used when it comes to a conventional or government-backed loan. But to keep in mind, there are 43 different versions, so there's always going to be a change in what you see and how you see it. But myth number 4, keeping your credit card balances below 50% always seems like a good idea. But when you're telling somebody to just keep your balances below 50%, and when you talk about credit card balances and how it impacts your score, kind of look at it as loan to value. You have a loan to value on your credit card. It's called your utilization ratio. So if you have a $1,000 limit, a $500 balance, you have a 50% utilization ratio. Now, when you keep that balance below 50%, you haven't done anything wrong. You're paying your card on time. But credit cards are based on an ABCD rating. And what I mean by that is you get points associated with your balance. So if you have 0 to 10% of the balance used, you're going to get an A, right? So 1% is going to be an A+, 9% is going to be an A-. And the thing to understand that is your credit score is ascending, not descending. And what I mean is you don't start out at an 850, which is a perfect credit score, and lose 20 points because of a late payment or 50 points because you have a collection. You actually start out at a 350 and gain points based on the types of accounts you have and how you use them. So credit cards, when you talk about just keeping your balance below 50%, that's only a C rating. So the closer to 0 you can get, the better. So keep that in mind when you're giving that advice. Always keep those balances as low as you can, or try to increase those limits because it has the same effect. Jump in here. Myth number 3, closing credit cards will help your credit scores. Makes sense? You don't want to have a lot of those lines out there. This is one of the most common things I see people with perfect credit and a great credit history, the mistake they make. And by doing that is you impact 65% of your score just by closing accounts. So if you get a 0% balance transfer in the mail and you think, I'm all right, makes perfect sense, I'm going to transfer my balance over to this brand new card, and then I'm going to close that old card out. Well, what you're telling your credit score is you just open up a new account, you close out an old account, so 65% of your score is impacted just by doing that. And most people think that it's just based on your credit history. That only makes up 35% of your score. 35% of your score is based on how you pay your bills. The rest is made up on the types of accounts you have, how you use them, and how old those accounts are. So if you do get the 0% balance transfer, great. Take advantage of that. But keep the other card open and active because your average age in file, the average age of the open accounts you have is really, really important. So if you do the 0% balance transfer, make sure you don't close out that old card. We see this all the time. Yeah.
So what happens when you have a card for many years and all of a sudden you get this letter in the mail that says
honestly, I always say that at least every 6 months, use the card. You can use the card and not be charged any interest for it. So go ahead and put a tank of gas on it, or use it at the grocery store, but pay it off before the bill comes. So you're not going to charge any interest. But you want to keep those things open and active, because credit card companies, actually, the people that don't use the cards or pay the cards off every month, is where they refer as deadbeats. Not the people that don't make their credit card payments. It's the people that pay that balance off every month because they don't make any interest off of that. So keep those open and active. Because if you don't use that card, typically what they do is that 6 month window with no usage, they'll close it out because they want to get that account open and active with someone else that's going to use the card. So try to use that at least once every 6 months. So even though you think your credit score is based on just how you pay your bills, that's only 35%. The rest is the amount you owe, the type of credit you have, how long that account has been open and active, and how it's used. So 65% of your score can be impacted just by 0% balance transfer and closing out that old account. So keep those open and active. Don't close the accounts when you do the transfers. Myth number 2, this one is really, I think, kind of an eye-opener. Paying a collection will actually increase your credit score. I have a collection, and I'm going to pay it. Should that have a positive or a negative impact on your score? You would think, common sense. Unfortunately, in the credit score world, there's less than a 2% difference whether a collection is paid or unpaid. The most weight's given to how recent the activity. So the older the collection is, the less impact it has on that score. And what happens when you advise a consumer to go pay a collection, now you have collection activity just last month. So if the consumer goes out, and we see this all the time in the mortgage process, the consumer goes out and gets pre-approved. They go to the mortgage lender, they have a good enough score to get approved, but they see a collection on there. And the lender explains to them that, well, you're approved, but you don't get the best rate out there. And that's because your score's a little low because you have these open and active collections. What's the consumer do? The consumer, during the mortgage process, goes and pays that collection and tells that debt collector to make sure you update my credit report to show that this is accurate. Now that consumer has collection activity in the last 30 days. That actually can make the score go down. During the mortgage process, approved for a home loan, goes and pays the collection, and their credit score goes down. And unfortunately, in today's world, your score impacts just all facets of your life. Not to mention when you can't get approved for a mortgage, a job, the price you're going to pay in insurance, when it's really, really important. So paying a collection can actually lower your score sometimes. And that's all based on the date of last activity. If it's a four-year-old collection, that's got next to no impact on your score because it's so old, but the consumer goes and pays that, and then now they've got collection activity just last month, can make that score go down. So when you're advising people, make sure that they don't update that last activity. Yes?
So you pay that, let's just say you've got someone and they said, well, I'm going to pay this old collection. Is there a positive result to that, having that collection off your credit card?
Sometimes, most mortgage lenders have requirements out there that you can't have a collection more than $500, and each lender's a little bit different of their requirements, so sometimes you've got to pay that collection, and you don't have an option in order to get approved. But when it comes to your credit score, it's not going to have a positive impact of just paying a collection. There's less than a 2% difference whether that's paid or unpaid. Once again, it's the most weights given to how recent the activity. So if it's an old collection and you pay it, it can drive that score down. If it's reported correctly and you just incurred the collection just last month and you pay it, it's not going to go up or down because it's right there. Is it back? Okay, we're back. All right, and now we get to my favorite. Your credit reports are accurate. I always like to have a little fun with this and kind of go around and guess. The price is right without going over. I'll take anybody guess what percentage of credit reports are accurate? 20, 30, 40, 50?
80?
80% are accurate? that what you're thinking?
Yeah.
Okay. 20? One more. Zero. Well, you're the closest without going over. The FTC did a report. 79% of credit reports are inaccurate. 79% of the people in this room have inaccurate information on their credit reports. What we're going to actually talk about, I mean, that's a big number. Here I'm going to actually show you some mistakes on a credit report, how to identify them, and to understand why they're there. This Millennium Financial is this top account. So Millennium Financial is a collection company. The original creditor was First Savings credit card. So it's a credit card that someone stopped making payments on. Now it's a collection on a credit report. One of your consumers. Now, it's coded in that first red box there in the middle as an installment loan. However, we just said that it was a credit card. Everybody understand the difference between a revolving account and an installment loan? Installment loan's like a car loan. It's a closed fixed term for 1 to 6 years. That's an installment loan. A credit card is a revolving line. So that balance can kind of go up and down, right? But it's coded as an installment loan, and because this top account's coded as an installment loan, even though that it's a collection, now it shows a past due balance of $370. See that second box? Past due. Same thing in the second one. Primary Financial Services is a collection company. The creditor was ADT. It's coded as well as an installment loan, therefore shows a past due balance. Does ADT loan money? Is ADT a bank? They sell security monitoring, right? They don't do installment loans. But this is coded as an installment loan and therefore shows a past due balance. So what this is doing, by reporting this way, it's telling your credit score that you're past due on 2 installment loans. Not that I have 2 collections, it's that I'm past due on 2 installment loans. Has far greater of an impact than it should. But this is inaccurate reporting. Collections that are revolving lines of credit, coded as installment loans, therefore shows a past due balance. Has a huge, huge impact on that credit score. I'm going to show you some actually accurate reporting. This is a lot harder to find than you think. But LHR Inc. is the collection company. It, as well as just like that first account we showed, is a credit card. It's coded correctly as a collection, not an installment loan. Therefore, it doesn't show anything in the past due balance. That's impacting the score the way that it should, because it's just reported correctly. Midland Funding, HSBC Bank, you probably all heard of them. Collection account, was a credit card, coded as a collection, therefore it doesn't show anything in the past due balance, because it's a collection. That's the difference of accurate reporting and inaccurate reporting, and it's affecting the score the way that it should. So these are common things, and these are mistakes that people don't realize that are there. When you're dealing with a consumer and they're like, yeah, I had an ADT bill that I didn't pay. They know that. Or they had a credit card that they stopped making payments on, or an ex-wife or ex-husband that stopped making payments on that. That was their responsibility. But they don't realize that it's reported inaccurate. And a lot of these aren't mistakes. Most of these things happen intentionally. Because the debt collector knows the more impact they have on that credit score, the more likely they are to be paid. So they're intentionally reporting these as installment loans as opposed to collection. It's cheaper to report an installment loan than it is to report a collection, because that's something you're going to do every month. So it actually saves them money, has a bigger impact on their credit score, more likely they are to be paid. So it's a business practice that works better for them. But accurate reporting, not only do I have the account, but is it reported accurately? Is it coded correctly? And is it impacting my score the way that it should?
What if your balance was in the negative amount that you're not going to pay because it's a credit, so it's going to show as past due? Does it recognize if it's a debit or credit?
It's really the most important thing is a 30-day window, which is a good question. If you're 15 days late on a credit card or a car loan or a mortgage, it doesn't impact your score. The biggest impact is once you go 30 days late. So if you've got, and this is great information to advise your clients on too, is to make sure that they never go 30 days late. And that's an easy answer, but if you've got not necessarily rob Peter to pay Paul, but if you're trying to manage something on a monthly basis, keep everything below 30 days. If you're 2 weeks late on your car payment, it's not going to impact your score. The biggest impact is when it goes 30 days. That's when they really start to pay attention. So.
Okay.
We'll jump in here. And here's just more examples. I've looked at this slide 1,000 times, but there's 8 collections here. 7 out of the 8 are coded incorrectly. You go on this top account we have over to the side. I like to use this as an example. The top collection is IC Systems. The original creditor is Sprint. It's coded as an installment loan. And because it's coded as an installment loan, it shows a past due balance of $450. So that's like an outstanding balance on an installment loan with a $459 payment. It's impacting the score far greater than it should. The next is Comcast Cable, coded as an installment loan. Medical payment data, it's a medical collector, coded as an installment loan. It's a medical debt, coded as an installment loan. Consumer collections, another medical debt, coded as an installment loan. And you see over here to the right, they're all coded I-9. I-9 is a code for installment. It should be O-9, which would be a collection code. Yeah.
Okay, installment loans are what kind of loans again?
It's a closed term, so it's like an auto loan. So I have a 4 or 5 year note,
Right.
and it's closed in. It's not revolving. The balance can't go up and down. You make a payment each month.
Okay, so
and you
that'll
have
be
set
the
terms.
differentiation on that, is that the balance can't go up and down, and it's closed.
Closed, yeah. It's closed in. You don't have options. You have a certain amount of payments you make each month, and it's amortized out. Like a mortgage would be 30 years typically, or 15. These are typically below 60 months. But all of these accounts, 7 out of the 8 are coded as installment loans as opposed to correctly coded as a collection. The correct code is 09. So this one account here in green, Executive Financial Consultants, it's actually a local company back in Kansas City. We refer to them as ex-FinCons or ex-cons, but it's Executive Financial. Tom here in the front row is super. So I just like to bring that up. These things are everywhere. It's on all reports. I'm going to show you several reports. 2 out of 5 here have mistakes, coded incorrectly. 3 out of 4 coded incorrectly. 4 out of 4 coded incorrectly. These are collection accounts coded as installment loans that are having far more impact than they should. And this is random. This is more common than uncommon in the industry. We see more mistakes than we see accurate reporting. 79% of credit reports have mistakes. Yeah.
Back a couple of slides, you mentioned something that was a medical. Is that a category in itself?
Yeah, no, medical collections, they impact they should all be coded 09. All collections should be treated the same.
Okay.
But medical debt, unfortunately, which is a big issue when it comes to your credit score. Consumers don't decide to go to the emergency room. They don't, go up, run up it's unlike going out and maxing out your credit cards and being irresponsible. But unfortunately, when it comes to your credit score, it impacts you the same way, whether it's a collection for a medical collection or just a past due balance. Later on in the slide, we're going to show you some statistics of the collections that are on your report and where those come from.
If it is coded as an installment, wouldn't the proper balance if there is a past due balance, say if you pay me $30 a month for 30 months, you're 2 months late, it should be $60.
Yeah, and just another inaccurate report.
Because it's coded as an installment, it shows the whole outstanding balance of the installment.
Exactly. And so you have a $300 medical collection counts as a $300 payment, and it shouldn't, and it shows past due. This is the last one on the credit reports, and I always like to show this. This top account here is Midland Credit Management. Coded I-9 as an installment loan is the top account, in red. Now, the second account is Midland Credit Management as well. It's coded correctly as 09, which is a collection impacting the score the way that it should. The reason being is that the consumer disputed that information. That's the big green circle there. Account information disputed by consumer meets FCRA. Has anybody ever heard of Midland Credit Management?
Yeah.
No, they're kind of a big deal. They sued more consumers last year than anybody else in the country. Midland Credit Management filed more lawsuits against consumers than any other company in the country. Huge debt collector, debt buyer. So, I mean, you see these mistakes. What happens when they don't fix these mistakes? This is my favorite part. Checks. Equifax, Transunion, Experian, Midland Credit Management right here in the center of the page. These are checks that are settlements that we've gotten for consumers. So when the debt collector, the creditor, isn't reporting correctly, they don't comply with the law, we go after them. That's the difference between us and any other credit repair company you'll see, is we go after creditors, collectors, and credit bureaus for not complying with the law. A lot of times you go in and you look at what's the process, how long does it take, and some of the most common. There's two federal statutes that we use. FCRA is the Fair Credit Reporting Act, and there's three kind of main focus or focal points when it comes to the FCRA. Is the information has to be accurate, and underneath the FCRA, it's not 98, not 99. It has to be 100% accurate. Incomplete information is inaccurate information, so it has to be 100% complete and accurate information. It has to be verifiable. It has to be verifiable in a timely manner. They have 30 days to notify you of your dispute and up to 45 days to complete the investigation. We use the FCRA to hold these guys accountable. If they don't comply with the law, we go after them. The second main federal statute we use is the FDCPA, which is the Fair Debt Collection Practices Act. And this is the law that the debt collectors have to comply with and the rules they have to follow. Some of the most common when it comes to this, statistically, the CFPB, the Consumer Financial Protection Bureau, is just actually released this in December. 31.6% of all credit reports have one or more medical collections on them. 36%. 67% of the collections resulted from unpaid bills rather than unpaid loans. So 67% of the collections out there aren't from somebody that incurred a debt and stopped making payments on it. It's because of medical collections. 3 out of 5 consumers are going to be contacted by a debt collector in regards to medical debt. 3 out of 5 people are going to be contacted by a debt collector in regards to medical debt. The numbers are alarming. 5% sample of credit reports. So 5% of credit reports had over 1,400 debt collectors on there. It is rampant. And these guys are all about collecting money and will report anything. And most consumers don't realize how to process the accounts and see where they're at. And most of this is just billing errors. My insurance was supposed to pay it, or I had a copay. And it's just billing errors, and all these mistakes are making it to consumers' credit reports, and it's affecting how they operate on a day-to-day basis, whether they get approved or denied for a loan, whether they get approved or denied for employment, the amount of insurance, the price of the insurance they pay. It has a huge, huge impact. But debt collectors have to comply with the Fair Debt Collection Practices Act. And one of the most common violations we see are voicemail violations. Debt collectors go to training, classes, seminars all the time on how not to violate the law. But when it comes to communicating with the consumers, it's like they just can't help themselves. And these things aren't calling up and cursing at a consumer or doing mean, hateful things. They have to disclose their identity, that they're calling, it's an attempt to collect the debt. But what they do is they leave voicemails that don't comply with the law, which are, hey, this is Bob Smith. It's really important that you give me a call back at 1-800-555-terrible debt collector, right? That is not compliant. They have to disclose that this is an attempt to collect the debt. Information be used for that purpose. And these voicemails that they leave all the time violate the law. And when they leave a voicemail and not comply with the law, the consumers can receive up to $1,000 for just a statutory violation of just not leaving the proper message when they communicate with consumers. So the voicemails are probably the most common. Third-party disclosures. They can't call your family members and disclose that they're a debt collector trying to reach you. That's one of the, probably the second as opposed to the voice notes, the most common, but they can't disclose that they're a debt collector attempting to collect a debt of yours to a third party. They just can't do it. Fair to leave the mini Miranda. The mini Miranda is this is an attempt to collect a debt. Information used for that purpose. When they communicate with you, they have to say that. And if they don't, they're not complying with the law. Written violations. This one is actually one of my favorites because it's just such black and white hard evidence. The Fair Debt Collection Practices Act says that it can't be deceptive to the least sophisticated consumer. And that's the bar. The bar set for the least sophisticated consumer. And when you get letters, their letters don't comply with the law. If you're the least sophisticated consumer and you get a letter from Leading Edge Recovery, right? They're a debt collector. Pretty easy. But who do I owe money to? Do I owe money to Leading Edge Recovery? Or do I owe money to LVND Funding? Or is it Citibank? There's 3 creditors listed on here. Who do they owe? The least sophisticated consumers are not going to understand that. This letter violates the law. And these are mailed out all the time. Consumers get these all the time. And they're just deceptive. But the least sophisticated consumer has to understand that communication. And if they don't, it's a violation of the law. Another example, Apex Financial Management, Original Creditor, Chase Bank, Walnut. Who do we owe? Is it one of the 3 or is it all 3? But the letters just don't comply. This one just looks like a check. It's a letter from the debt collector that looks like a check. That was kind of a bad day. Then you're getting a check and you owe $51. That's a big deal. What happens when they mail these letters out to consumers? It's back to my favorite part. Checks. This isn't attorney's fees. This is money that the consumers have gotten because they violated the Fair Credit Reporting Act and the Fair Debt Collection Practices Act. So these are checks that the consumers got, as opposed to that $51 collection. The consumer gets $1,000, and we get the information off the credit report. All about helping consumers. So the basics of the Fair Credit Reporting Act and the Fair Debt Collection Practices Act, these guys have to comply with the law, and if we don't, we hold them accountable.
Can I ask you a question?
Sure. Yeah.
So, when you're recovering and helping someone repair their credit, is there a statute of limitations on the length of time? Let's say someone's let it go for years. Is there a length of time?
Yeah. Good. Great question. When it comes to your credit score, you always have to be concerned. There's kind of 2 statutes of limitations. One is how long you can report on your credit, and then how long they have the legal right to actually take action, meaning sue you, get a judgment, and collect that debt. When it comes to your credit report, it's 7 years. The most common answer is 7 years. There's some things that can stay for 10 in the public records, like a tax lien, a bankruptcy, can stay 10, but it's 7 years. After 7 years, they can't do anything. So it's 7 years since the date of last activity. And what that date of last activity is going to be based on the last payment that you made. And these debt collectors, they know that. So a lot of times you might have a $1,000 collection out there, and somebody's going to call and send you letters all the time and try to get you just to make a payment. That re-ages that account. So it starts at 7 years over. So if you haven't made a payment for 4 or 5 years on an account, and they get you to make a payment, now they just stretch that out again. And it's a common practice. That's what they do, and they do it because of that. But
So if you're repairing that credit, then you can go back that 7 years with incorrect reportings and all other things.
yeah, we can go all the way back. When you audit, it has to be. This is one thing to keep in mind too. It's accurate. Accurate deemed by the FCRA is 100%, not 98, not 99. It has to be 100% accurate. And the most common thing is incomplete information. Incomplete information is inaccurate information. So if they don't have all of the information there, or they can't report all the information, they can't report. So they have to be 100% accurate. Our time frames, when you talk to people about credit repair, you always hear catchy phrases, it's a process, it takes time, you didn't get here overnight, it's going to take a long time. Well, it does take time. Federal law states that it's 45 days. So a long-term client for us is 120 days, a short-term client is 30. We'll have done what we can do for that consumer and put them in a better place, hopefully, but it's in a short amount of time. This doesn't take months, this isn't years. Federal law dictates that they have 45 days to comply and complete the investigation, and we go after them for that. So we see a lot of consumers that we fix up really quickly. So it's not talking about building a pipeline or database. We get them back to you as quick as possible. When it comes into our cost, so we talk about time, now you talk about cost. This is the easiest thing for us to explain. Consumers only pay for what we get deleted and when we get it deleted. So you're not paying us for trying to work on your credit report. You're not paying us to try to help somebody. You're only paying us for what we get deleted and when we get it deleted. Late payments are $30. Collections, repossessions, charge-offs, public records are $65. Bankruptcies and short sales and foreclosures are $120. And that, once again, is only if we get the information deleted. If we don't get an item deleted, your client doesn't pay us any money. Here at the end, I'd like to answer any questions. Anybody have any questions about what we talked about today? Yeah.
I have a question about green tree. I read absolutely screamingly horrible things about it. A lot of people call them green tree. We have a fellow now that's trying to sell his house without doing a short sale, but he has other bills that he has to pay when he does that. They won't even short sale him like $5,000. He was like $180,000, and they would take an offer at $182,500 or whatever. And I looked into them. They're like not a mortgage company. They're a debt collector. They say they're a debt collector, but they won't say what they are.
Yeah,
it's really hard to work with them because you don't know what they are.
Yeah, they're a servicer, and they only service delinquent loans. So you have Aquin and Green Tree, for example. So like every delinquent Bank of America mortgage gets transferred to there to be serviced. Was that last week that we dealt with Aquin? And Aquin actually came out and were on the phone trying to sell an account for a consumer. And Aquin's not foreclosing. Not foreclosing on any properties right now. And they're openly admitting that, even though they're starting the foreclosure process all the time. But it's just to try to collect the debt. It's just right. Yeah.
It was my understanding that Green Tree originally started in the mobile home lending business.
Yeah.
So now they've transformed into this other mode.
Yeah.
Now, I have another question. My brokerage is under the Vail Corporation, and they're constantly trying to get me to buy in to their credit monitoring. And telling me that I can personally go in and change what's on my reporting. And anyway, I was talked down to last week very strongly by this lady at Dun & Bradstreet who was trying to sell me this subscription, and of course, I didn't buy in, but
Yeah, Dun & Bradstreet, that's your business credit profile. And that is probably the best group of salespeople I've ever met.
oh man,
Ever. They are good. If they're offering it, you don't need it. That's on your business credit profile, which is going to be based on your EIN, not your social security number. But it's irrelevant. But Dun & Bradstreet sells anything and everything to everybody. Well, yeah, no need for that whatsoever at all. But that's in your business. That's one thing to kind of keep in mind when it comes to that too. Like when it comes to your business credit profile, the Fair Debt Collection Practices Act doesn't cover that, because if it's a business debt, it doesn't fall under that same set, and/or there's no FCRA when it comes to, or Fair Credit Reporting Act when it comes to your business credit profile. But but talking about Green Tree and Aqua as well, same thing. Yeah.
Is there a difference in how your credit's affected if you're looking at a chapter 7 versus 13?
going to be bankruptcy, so it's a public record. The main thing to understand there is when you have a chapter 7 and a chapter 13, a 7, you're going to discharge the debt, and that's stopped, and once everything's discharged, you start to recover. A 13 is where you make payments to the trustee for typically 5 years now. So it's longer to recover from the 13 than it is the 7 because it just stays open and active for a little longer. But the difference between the 7 and the 13 is going to be based on how much money you make. If you make above the median income, where you're at, you're not going to qualify for a Chapter 7, so you're going to actually have to file a 13. And the 13 is one of those things it's going to have a negative impact on your credit. You're going to make payments for 5 years. So if you can avoid it at all costs, I always try to say that. But yeah, 7 you're going to recover far quicker than you would a 13. But it's going to stay under report for 10 years, whether it's the 7 or the 13. Any other questions? Yeah.
You didn't say anything about student loans, and I've got adult clients that have student loans.
Yeah, student loans, big conversation, but it's pretty simple to look at it. There's two things you can do with a student loan. At the end of the day, there's two things you can do. You can consolidate the student loans into one loan, make one monthly payment. If you're delinquent on the accounts, you can do what's called a rehab process, which is really good. It's pretty simple. You don't have to pay somebody to teach you this or walk you through the process. The rehab process is if you're delinquent on a student loan, they give you the opportunity, they've already got it built, even when it comes to your credit scores and your credit report as well. If it's delinquent and a claim's been filed on those student loans, you can go through the rehab process. And what it is it's a 9 to 12 month payback. So you make payments for 9 to 12 months, you pay those on time, you're through the rehab process, they resell those student loans to a new company and remove the derogatory information and the coding off your credit report. So there's already procedures in place to help people recover from that. But either do the consolidation if you're past due, or if the consumer's past due, they need to do the rehab process, which is a 9 to 12 month payment plan and gets them back on track. Yeah.
Okay, on that, I have several parents that co-sign for the children, and they don't realize how much it's going to go through debt ratio.
Yeah.
And they feel like they're hurting their kids if they make them go into a loan to pay it off. Is there a fix for that? And is there...
Now, when it comes to co-signing, you're obligated to pay it. So they're going to count against your income to debt ratios. It's going to impact your score. Typically, you always say the co-sign, typically not a good idea. you don't know if the payment's going to be made. You hope the payment's going to be made. But unfortunately, it's the same thing whether you make the payment or not. If they make a mistake, it's going to hit your credit. And it can have a huge impact on whether it's qualifying, because you're going to have to qualify with the payment, but it's also going to impact the score as well. So unfortunately, when it comes to co-signing, there's not a lot of options if you have to or you want to, but it's going to impact your score and how you qualify. So, for sure. Yeah.
Okay, so we've got a client that maybe has pretty good potential, works for a solid company, has been working with them for 7-8 years. And we want to help them out. They want to buy a house. They're not going to buy a house this summer, but they might buy a house by next fall. What do? We tell them to call you guys? Is that how it is?
Yeah, no, actually call us, because not only, when it comes to the credit score and the repair process, it's not just about removing information from the credit report. Sometimes it's about establishing credit. And we help with that too. So we'll help the consumers get a revolving trade line, regardless of the credit score. Help them get an installment loan, regardless of the credit score. No credit is the same as bad credit, right? So you talk about those first-time buyers that have no history. It's the same thing that happens with bad credit. So until you establish a credit profile and history, you're not going to generate the score you need to be able to qualify. A long time ago, I say I'm a recovering mortgage banker, but it used to be, when I first started originating loans, the credit score was irrelevant. You looked at their history, how they paid their bills, the assets, the income, and that's how you decide if you approve a loan or not. Now all those questions are irrelevant unless you have a credit score. So unless you're a 640 or a 680 or a 720, that's going to determine whether you get approved or not. So, but no credit profiles, we help that as well. There's a lot of great options out there for revolving trade lines that's going to report to your all three bureaus and help you establish a profile. Also, installment loans are the same way. If I would encourage everybody, if you deal with a lot of first-time home buyers that you run into this a lot, talk to your local banks. Your local banks they'll typically do what's called a CD builder loan. And a CD builder loan is where the consumer goes in and borrows $1,000, $2,000, but then they also purchase a CD with that amount of money. They use that as collateral for the loan, right? So they borrow $1,000, purchase a CD. Same time, the money never goes anywhere. And they make those payments for 12 months. What you can do with your first-time buyers is encourage them to do that. And if they're talking about buying, let's say, a $100,000 house, have them go to the installment loan for $3,500, 3.5% down payment. So 12 months from now, they've got an established trade line, and they've saved their down payment for the purchase of a new home. But most your banks, most your credit unions will actually do those loans, the CD builder loans. So it helps a lot too. But you can check out our website. It's creditlawcenter.com. There's great information on there about establishing credit, how and what you need to do in order to do that. Another great resource is actually a website called freecredithub.com. So if you go to freecredithub.com, there's credit card offers there that are geared towards a thin credit profile or even bad credit. There's also great information there on monitoring your credit, how to get a copy of all three reports and what's on there. Yeah.
Did you say that again? Free credit?
Yep, freecredithub.com. Yep, hub. H-U-B, yeah. So.
We were at the United Power class last month, and you were excellent. Everyone was raving about it. But this freecredithub.com, you mentioned there was a $7 charge somewhere. If you got all three credit reports on one page, the way you like to see them compared, is that the same?
Yeah, that's on freecredithub.com. What there's a link on that website. It's through a company called Identity IQ, and they actually only charge $1 for the first 7 days. And that'll get you a copy of all three reports. And inside of that credit monitoring, you can actually update your credit report once every 30 days to see what's reporting, and you get alerts for that. Because keep in mind, you hear about freecredithub.com, or not freecreditscore.com. There's nothing free about it. It's mislabeled. That's actually 1999 creditreport.com is what it should be called. They charge for those. And most of those companies, when you go out and look at those, they'll charge you a monthly fee for monitoring the report, but not giving you a copy of the report. So you get an alert that something changed on your report, you have to pay $20 to go see it. At freecredithub.com, though, that's Identity IQ. There's a discount code in there. So it gets you all three reports for $1. They're all together on one page. Really easy to use. When we start to dispute information, or a client retains us to go to work for them, we do have them enroll into credit monitoring. That way we can update the report through the process so you can see what we got deleted, when we got it deleted, and the consumer knows. So, yeah.
There used to be a list of criteria that Fair Isaac uses to profile the public, and I haven't been able to find that list for years. Do you know if there's a place? The first time I saw it, I was shocked. What color you are, what age you are, where you live, what you drive, all those things, how many children you have, all impacted the credit score. But then I guess they decided it was politically incorrect to let the company know their profiling techniques, and I was wondering if there's still a website out there that'll give you the information on the inside scoop.
I wish there was. I scour the internet and read constantly on that, and that information they don't put out there. They don't want that information out there because then people can manipulate and try to improve it. But yeah, move or tell them different things. So, But yeah, the bureaus, they do, all they do is sell data. So at the end of the day, realize they sell data, and whether it's good data or bad data, they sell data, information. That's what they're there for. But, I want to thank you all for your time today. Hopefully, you found some good information. Really quick, we're going to do a drawing. Keith, you want me to draw the card there for the camera?
Make one last run.
Yep, one more run for cards real quick, and we'll draw for the camera.
Good.
We don't have any time.
All right, everybody got a card in? So he has 8 cards.